Welcome to the Stake New Money Investor EQ series, where we explore the hidden forces that drive investor behavior and how to overcome them to make smarter decisions with your money. In this video, we're going to be looking at investing setbacks, specifically how to manage them so that they turn into useful learning moments as opposed to absolute disasters. Let me start this episode with one of my own investing mistakes. Back when I first started out, I bought into a small Australian company simply because I heard a fund manager recommending it on YouTube. Yep, I didn't do my own research, I didn't read the financials, I didn't even really understand what the company truly did, but I bought in anyway because in my mind, this person sounded smart. I assumed they must know what they're talking about. But within a few months, the stock had dropped by 72.5%. Now, at first, I told myself it was just a temporary dip and to trust the fund manager's brain, but deep down, I knew I hadn't actually done the work. I'd handed over my decision making to somebody else, and when the losses mounted, the panic kicked in. I checked the price every day, hoping it would bounce back, and feeling worse each time that it didn't. If we think back to last episode, this was a perfect example of how emotions and shortcuts can sabotage good decision making. I fell into authority bias, confirmation bias, I felt loss aversion, and ultimately, regret. But here's the truth, mistakes are just a part of the journey. Every investor makes them. What separates successful investors from the rest is how they respond to those setbacks, whether they use them to reflect and improve or let them spiral into bigger problems. So in this video, let's talk through a simple 5-step process that you can use to recover from any investing mistake. The first step is to acknowledge the mistake fully and honestly. Now that sounds simple, but in reality, it's one of the hardest things to do. When you lose money on an investment, it's easy to blame external factors. The market turned, the economy shifted, the company disappointed on earnings. And while those things might be true, they don't tell the full story. The deeper question is, what part did I play in this? In my case, I didn't lose money because the market was volatile. I lost money because I outsourced my thinking. I heard a fund manager speak confidently in a YouTube video, and I let that confidence substitute for my own conviction. I didn't look at the balance sheet. I didn't read the annual report. I didn't even know what the company's long-term risks were. I just clicked buy, and when the stock dropped 72.5%, I didn't know what to do because I never truly knew what I owned in the first place. So acknowledging a mistake like this is definitely painful, but it's also incredibly powerful because once you take full ownership of the decision, you can start to see it for what it really is. It's just feedback. It's not just about the fact that you lost money, it's about what the mistake reveals about your process. Were you chasing hype? Were you overconfident? Were you investing out of boredom or fear of missing out? This kind of honest self-reflection is how you build what Warren Buffett calls an inner scorecard. You stop judging your success based on short-term outcomes and start measuring it based on the quality of your decisions. And the only way to improve your decision-making is to look past mistakes in the eye without flinching. Mistakes are inevitable in investing, but repeating them is not. Once you've acknowledged the mistake, the next challenge is to manage the emotions that come with it. And believe me, this is often harder than the financial loss itself. Losing money feels far more painful than gaining money feels good, a concept known as loss aversion. Your brain is wired to avoid pain. So the instant you see red in your portfolio, every instinct screams, do something, sell, get out now. Or worse, double down and make it back fast. I've been there. After that 72% drop on my first stock, I remember logging in every day, watching the price tick lower and feeling a wave of regret and panic. I wanted to act. I wanted to fix the mistake, but deep down, I knew any decision that I made in that sort of emotional state would probably be wrong. And that's when I learned the importance of pausing. When you're in the middle of an emotional storm, the best thing you can do is just step back, create space between the emotion and the action. Give yourself a rule like waiting 24 or 48 hours before making any big trading decision. Mohnish Pabrai famously only puts in buy or sell orders when the market is closed. That cooling off period allows your rational brain to catch up to your emotional brain. So if you can, talk through it with someone you trust, a friend, a partner, or even just your journal. The simple act of saying, I feel panicked because I lost money, helps separate the feeling from your decision. Another powerful tool is simply zooming out. Look at the long-term chart of the market. Remind yourself that setbacks, even big ones, are just part of the process. Volatility is normal. Every successful investor that you admire has been through their fair share of gut-wrenching drops. But the reason they're successful is because they didn't let those moments drive irrational decisions or stop them from investing. Controlling your emotional reaction doesn't mean you ignore the pain or pretend the loss doesn't hurt. It means you recognize the feeling, but you don't let it take the wheel. Then once your mind is clear, you can assess the situation logically, and that's when you start rebuilding. Once the emotions have settled, it's time to zoom out and take a hard look at your overall strategy, if you had one to begin with. A lot of people make investing decisions without any clear framework. They buy stocks based on hype, headlines, or what someone else is doing. And that might work for a while until it doesn't. When setbacks hit, it becomes painfully obvious whether you had a solid plan or you were just winging it. Now, this step is about coming back to basics. What's your actual investment approach? Do you have a long-term plan? Are your investments aligned with your goals, your time horizon, and your risk tolerance? For example, if a 20% drop in one stock wiped out your confidence or made you feel, physically sick, well, that's probably a sign that your portfolio may be too aggressive for your temperament. Now, that doesn't mean you can't handle any risk. It just means that your strategy and your psychology are out of sync. This is also where diversification plays a critical role. In my early mistake, I was too concentrated in one speculative company. I didn't have a broad base of stable investments to cushion the fall at the time. If you had told me to consider buying a diversified ETF instead, I would have said, what's an ETF? If you're heavily invested in just a few stocks, or worse, in a single stock or a single industry, you're not really investing. You're making a big bet. It's almost like a gamble. And the more concentrated your portfolio is, the harder it is emotionally to watch any one position fall apart. So revisit your plan. This means going back to first principles. What kind of investor are you trying to be? Passive, active, or a mix? What asset classes are you buying? Stocks, bonds, ETFs? Are you diversified across sectors, geographies, risk levels? This might also be the moment that you realize you do need to formalize your strategy. So write it down, define your rules for buying, for holding, for selling. Set your asset allocation, whether that's something like a 60-40 portfolio, a Bogleheads 3-fund approach, or a core and satellite mix. The goal isn't to make your portfolio bulletproof, it's just to make it resilient. A portfolio that reflects your goals and risk tolerance won't prevent losses, but it will help you stay calm and committed when the losses inevitably come. And that, more than anything, is what keeps investors in the game long enough to win. At this point, you've acknowledged the mistake, calmed your emotions, and revisited your overall plan. Now it's time to shift your focus to what you can actually control, because here's the hard truth. You can't undo the past. You can't rewind the market. You can't force a bad stock to be good again. And the more time you spend obsessing over what went wrong, the more power that loss continues to hold over you. But what you can control is what you do next. You can control how much you save and invest going forward. You can adjust your asset allocation to better reflect your risk tolerance. You can commit to dollar cost averaging instead of trying to time the market. You can pay attention to the fees you're paying, reduce over trading, and eliminate emotional decision making. These may not sound exciting, but they're where real investing success comes from. In fact, research has shown that investor behavior, not stock selection, is one of the biggest drivers of long-term performance. The ability to stay consistent, to contribute regularly, to ride out the ups and downs. That's what builds wealth over decades, not flashy trades or perfect timing. So instead of trying to win it all back or outsmart the market, focus your energy on building good habits. Reinvest your time into learning, improving your process, and refining your mindset. This is where you take back control. Every investor, whether they're managing $1,000 or $1 million, has the same levers to pull, and most of them are internal. The good news is, you don't need to fix everything overnight. Just focus on one thing you can do better today than you did yesterday, because if you keep doing that, the results will compound. After a setback, it's natural to want to bounce back quickly, to make your money back, to prove to yourself and maybe to others that you've still got what it takes. But this is one of the most dangerous moments in investing, because the desire to catch up often leads to more mistakes. This is where you need to take a breath and rebuild slowly, methodically, responsibly. One of the worst things you can do after a loss is swing harder. Doubling down on risk, chasing the next hot stock, or throwing your entire savings into a single idea just to break even. That's not really a recovery plan, that's revenge trading. And more often than not, it just digs the hole deeper. So instead, come back to your strategy, whatever version of it you refined in step 3, and recommit. That might mean going back to basics, a consistent dollar cost averaging plan into diversified ETFs and keeping things boring. And that's okay. Good investing is oftentimes very boring. Warren Buffett, the best investor in the world, describes his approach as lethargy bordering on sloth. The real excitement comes from watching your plan work over time, not from trying to win back a loss overnight. And if you're rebuilding after a big setback, it also helps to keep your goals in sight. Why are you investing in the first place? Retirement, a house, financial independence? Zooming out to that bigger picture can help you realize that this one mistake, while painful, is just a small bump in a much longer journey on a much longer road. And remember, some of the best investors in the world have also made massive errors. Buffett has made a heap.
I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and could have bought the whole company for practically nothing.
But what makes them successful isn't that they never lost money. It's that they didn't let the loss define them. They learned, they adjusted, and they moved forward with discipline. And you can do the same. At the end of the day, mistakes are just a part of the investing journey. What matters most is how you respond, and this 5-step process can really help in turning your missteps into really valuable learning opportunities. Acknowledge the error, stay calm, revisit your plan, focus on what you can control, and rebuild with discipline. Remember, setbacks aren't the end, they're just a time to reset, to take stock. And if you handle them well, they can become your greatest teachers. So let me know in the comments below, are there some investing mistakes that you've made as an investor, and how did you respond when you made them? Hopefully better than me when I made my first big error. But with that said, I hope you've enjoyed the Stake New Money Investor EQ series. Good luck with your investing, and stay tuned to Stake's socials for everything else you need to keep up with today's markets.